I think gold and silver and platinum are bottoming out around here. I own mostly gold and probably also silver. I think the mining stocks are more volatile. Then, if you believe in a bull market, I think silver and platinum will do better than gold. Not many, say 20, 50 people. They then control huge companies, have a huge influence. It's very centralized. That's what we see in the stock market also. It's not a broad-based rally. The Fed has kept interest rates artificially low. It could be that for the next few months, bonds will outperform stocks. The Japanese economy was in a disastrous condition at no time. I think the average person is to a large extent screwed. I have to laugh when I hear the US is helping someone. When in history has the US really helped someone else? Everything they did in foreign policy.
Well, let's talk about gold, Mark. The last time we spoke, it was not too long after the Iran war started.
Yes.
And you explained very clearly why gold reacted the way it did, likely because of, liquidity issues. Well, what about now, Mark? Where do you see gold at this stage of its bull market or technical bear market at this point?
Again, nobody knows for sure what the price will be in 1 year's time. But I would answer your question this way. Let's say you are an individual. You have 100, say 100 million or 100,000, and this is your liquidity and your assets. And you ask me, Mark, what should I own? What should I own with this 100 or 100,000 or 1 million or 100 billion? Then I would tell you, I would uh, own some stocks because in the long run, shares have tended to perform the best of any investment class, better than bonds and better than cash and better than real estate, if they were invested in reasonably good companies. Because then we have to define what is a reasonably good company. You understand? It's an endless process. I'm just saying that stocks, I would own some stocks. And I would own some cash because it allows me the opportunity or gives me the opportunity to buy something when I see something attractive. And then I would own some real estate because I feel that people would consider it to be safe to own your own house, and you can enjoy to buy the house that you want.
Wall Street keeps celebrating certainty, while the smartest investors keep preparing for uncertainty. Marc Faber notes that portfolio resilience matters more than predicting next year's gold price, yet most headlines still obsess over short-term forecasts. That's the contradiction institutions quietly exploit, while retail chases certainty that never arrives. Diversification is less about maximizing returns than surviving policy mistakes that destroy purchasing power. Next, Marc Faber reveals why his preferred inflation hedge isn't necessarily the asset most investors expect.
You don't have to buy a house because we don't live under socialism and communism where the government says you must live here or there. No, we can choose. And then the third option is to own some stocks through, say, an index fund, or through you choose 10 good companies or 20 good companies and you buy a basket. Or some people will buy just one stock and so on. So everybody has to decide. And my view would be that you have to own some precious metals instead of just dollar cash. I prefer to own precious metals because they're not printing precious metals. But as I mentioned to you last time, precious metals can come under pressure. If people need liquidity, then they can liquidate precious metals. But in general, I think all of you and all of your viewers should buy some precious metals, not once, every month of their lives.
Yes, and
Not put all your money in precious metals, but if you have 100, I would put maybe 25 in precious metals.
yes, and would that be mostly gold in your view, Mark, or do you also like silver and platinum as well?
I think platinum will outperform and probably also silver, but I own mostly gold. But as an investor, I'm not only buying things that I think will do best. I like also, when I look at the portfolio, I have different companies. I like companies that pay, say, a regular dividend, say 7%, and companies that can grow over time a little, say 3-4% growth every year.
Central banks keep expanding money over decades, yet physical precious metals remain impossible to print into existence. According to Marc Faber, accumulating metals consistently matters more than trying to perfectly time every correction. Institutions understand liquidity crises create temporary price weakness, but they often treat those moments as accumulation opportunities instead of exit signals. For long-term savers, disciplined ownership can matter more than flawless market timing. Next, Marc Faber exposes why platinum may be sending a signal the gold market hasn't fully recognized.
And the dividend yield. So this is enough for me. I have modest ambitions in life.
What about mining stocks, Mark, a sector for people who have a lot of ambitions usually? How do you view that sector?
I think the mining stocks are more volatile. And let's say, I think gold and silver and platinum are bottoming out around here. I would have preferred for them to go down further and bottoming out at, say, another 20% lower, but it may not happen. But then, if you believe in a bull market, I think silver and platinum will do better than gold, my belief. But I'm not going to change my gold position into silver and platinum. I'm happy with what I have. I'm happy if gold does not go down. This is my my view.
Yes, I fully understand that. May I ask you this question, Mark? So you mentioned that you believe that the stock market likely, peaked down here. What does that mean for the economy and an average person for the next few years? If that's correct, how would that affect an average person?
Well, I think the average person is to a large extent screwed. In other words, he will face a lot of hardship because the governments at the present time, especially in the US, are favoring the super rich. In other words, the asset holders. You understand? When you print money, the one thing that has happened throughout history in every society is the poor people and the middle class, they lose out, and the wealth concentrates into a handful of people.
The greatest investment risk may not be market volatility, but silent erosion of your purchasing power. What Marc Faber is highlighting is that asset inflation consistently rewards owners while currency debasement quietly punishes wage earners and cash savers. Mining shares may amplify upside, but they also magnify emotional mistakes when volatility strikes. Investors protecting wealth should distinguish temporary price swings from structural monetary trends. Next, Marc Faber unravels why rising inequality may be an intended consequence rather than an accidental policy failure.
Not many, say 20, 50 people, they then control huge companies, have a huge influence. It's very centralized. And that's what we see in the stock market also. It's not a broad-based rally that we have. We have a rally in, say, 50 stocks in America, and then 2 stocks in South Korea and 3 stocks in Taiwan and so forth. But it's not broad-based. And I think there is, for an investor, an opportunity to buy what is neglected. In other words, the speculators, they focus on Nvidia, Tesla, and Micron technology and whatever. But the broad market offers, and especially in emerging markets, offers many stocks that are inexpensive. But inexpensive, I have to say, is relative to what is very expensive. On their own, they're not that cheap. They're in some cases cheap compared to the bond yield, because some bonds are yielding, say, 2%, and the stocks are yielding, say, 7% dividend. Then the stock is relatively cheap compared to the bonds. And some bonds are relatively cheap compared to the stocks, because they yield, say, in America, the 10-year treasury, say, over 5%, is maybe not such a bad idea compared to Nvidia and to Micron technology, you understand? So I'm not saying it's more complex than before, but I believe that the active fund manager will perform better than the index funds. That is my view.
Right. And would you be surprised, Mark, to see yields going higher, even higher than they are right now?
Maybe. But yes, in the long run, I think they will go higher because they didn't go up sufficiently. And the Fed has kept interest rates artificially low. But it could be that for the next few months, bonds will outperform stocks.
Everyone is chasing the same winners, while overlooked markets quietly become statistically more attractive. Marc Faber's argument suggests today's concentration resembles previous periods when narrow leadership masked weakening market breadth beneath the surface. Institutions study relative value, while retail investors often chase whatever dominated yesterday's headlines. Ignoring neglected sectors can become far more expensive than missing another momentum rally. Next, Marc Faber reveals why higher bond yields could completely change today's most popular investment narrative.
But I find it very difficult to really define a lost decade. I mean, I'm a stock investor. I'm an investor in the financial markets. I could argue Japan after 1989, after the peak of the Nikkei, was for 3 decades a lost country, because the market never made a new high. But the bond market rallied, and I went every year to Japan. At no time did I feel that the Japanese economy was in a disastrous condition. At no time. Japan was always clean. Everything was running on time. And the service sector and the manufacturing sector were close to perfection. So one didn't have the impression of a country that was in recession. And yet people say it was a lost decade. So for me, it's very difficult to define what is a lost decade. It's the same. I live in Thailand. People say, oh, it's a failed state. This is not my view. The country functions reasonably well because the government doesn't do much. It stays out of the economy more or less. And it's a pleasant country to live. You understand? The well-being of people does not only depend on the stock market making new highs. That I want to stress. If the stock market keeps on making new highs, and each time you go onto the street, you're worried of being knocked down by some crazy guy, it's not very pleasant. You understand? So I think that why do people pay high prices for properties in Singapore and Hong Kong?
Markets can stagnate for years while everyday life remains remarkably stable, and history repeatedly proves that distinction matters. This is where Marc Faber's thesis shifts from financial returns toward the broader quality of economic life that markets alone cannot measure. Investors often mistake stock indexes for the economy itself, overlooking infrastructure, safety, and governance. Protecting wealth also means understanding where capital and people genuinely want to stay. Next, Marc Faber exposes why global capital consistently rewards stability before it rewards growth.
Part of the reason is the great infrastructure these countries have, and number two, the safety. You can walk around, and that applies to most countries in Asia. You can walk around Singapore, Hong Kong, Thailand at night at 4 o'clock, drunk and so forth, and nobody will knock you off and steal your wallet. It's not going to happen. It can happen, I mean, 1 out of 1,000,000 cases, but usually it won't happen. Whereas when you walk around alone at night at 4 in the morning drunk in Chicago, Baltimore, San Francisco, and so forth, it may be dangerous. That's what I'm told. I don't live there, but that's what I'm told. And that's what I read. The papers are full of incidents.
Since you mentioned Japan, if we could talk about what's happening to their currency right now, we are hearing that, the US are willing to help Japan to stabilize the yen. And of course, likely they're trying to help them because they're worried about, well, their own bond market and how much
Yeah.
bonds Japanese actually hold. So do you see that as a problem, Mark? Do you think that could escalate?
I have to laugh when I hear the US is helping someone. When in history has the US really helped someone else? Everything they did in foreign policy was with an objective to achieve some own goals, some own games that they intended to win.
Governments rarely intervene in currency markets without protecting a larger strategic interest behind the scenes. Marc Faber notes that geopolitical cooperation often follows financial incentives rather than public diplomacy, a distinction investors ignore at their own risk. Currency stabilization can be less about helping allies than preserving sovereign debt markets and funding conditions. Watching capital flows usually reveals intentions long before official statements do. Next, Marc Faber reveals why foreign policy and monetary policy are often two sides of the same strategy.
To get some advantage, whether it was the intervention during the First or Second World War, or later on in the Suez Crisis and so forth and so on, or the interventions in Iraq and in Afghanistan, they were not there to help. They were there to gain an advantage. And my view about this is when I analyze or think, would I want to live in a country that is, say, controlled by China or Russia or the US? I think I would choose the US because it's so disorganized that for them to control you would be quite difficult. They may try to do it, but I think it might turn out to be quite difficult.
Official narratives often describe geopolitical actions as humanitarian, while strategic interests tell a different story. According to Marc Faber, major powers consistently pursue policies that strengthen their own influence first, regardless of the public justification offered. Investors who separate political messaging from financial incentives are better positioned to anticipate capital movements. Markets usually react to incentives, not speeches.